Hey everybody, it's Mark Yegi. I hope you're doing well. Tomorrow there's a big Fed meeting, so I'm going to be talking about that for the next couple of minutes here, about what you can expect. And for me to be able to talk about this, I always go to my expert, Juicy Joe, because Juicy Joe knows a lot about what's going on in the financial market. So I usually take my lead from him because he knows a lot of what's going on. And he's got some ideas about what's happening with the Fed. So let's talk about what's happening with the Fed and what maybe he's planning on doing about it. Not that you should copy anything that he's doing, because this is financial education. This is not financial advice. Do your own homework, do your own research, seek professional advice, yada, 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 all that stuff that you should do. But I look for my expert, Juicy Joe, to tell me what to do. So here we go. The Fed is expected essentially to cut 25 basis points. Now, there are some people out there that think they're going to cut 50 basis points, and there's some other people that think they're going to cut zero just to be able to stick it to Trump, because they have a little war going on. Trump is not a big fan of Jerome Powell. And so I think at the end of the day, you're going to get a 25 basis point cut, which really doesn't mean a hill of beans in the scheme of things with the inflation or the interest rates around 5%, 6% right now. So inflation is sticky. The labor market is softening. Tariffs are adding uncertainty. And who knows, but the market may sell off if the Fed underdelivers. And a lot of that's not the rate cut, but what they say going forward, the whisper stuff. So Juicy Joe is like, hey, I think the risk is to the downside, so you got to protect your account, protect yourself to the downside. Don't be chasing the upside, although it feels like this market has been melting up for a couple of months now. Don't be chasing the upside. That's what he says anyway. So his core strategy is to sell deeper in the money covered calls. Now, if you know what I talk about on this channel, I'm a big believer in those in the money covered calls because they protect you. And let's talk about why. Because if you go deeper in the money, you get extra downside, okay? You get the cushion on the downside. That in the money amount is cushion to the downside. That's called the intrinsic value, by the way. I call it the protection amount or the cushion. And the larger upfront premium you get, part of that is the in the money. The other part is the juice. That means that juice is got income component to it, and then you've got the in the money component to protect the downside, okay? You get less sensitivity to the Fed-driven sell-off if that happens, right? If you're out of the money, you don't have a lot of in-the-money protection by definition, right? So the trade-off is if the market goes up, you don't get to participate in that. Well, if you've studied the last several Fed cuts or Fed announcements, the market is just wild and wicked and crazy and volatile. And so we're probably going to get a bunch of that. So you got to be prepared that if you can't handle that, then you should be really protected. And that's what Juicy Joe is doing. He's playing this as a defense over offense strategy. So what are some Fed risk scenarios versus Joe's position? Well, he thinks that if there's a Fed cut and a cautious tone, the market's going to drift lower, and that's why he's selling those deeper in the money calls. And that premium is going to protect the drop a bit. If there's no cut, in other words, they all of a sudden become hawkish and they want to lower rates or lower them more than people think they're going to lower the rates, the market may sell off because of that expectation, and Joe's intrinsic protection is going to help there. If they're, let's say, an unlikely 50 basis point cut, according to Juicy Joe, the market is going to rally, and that means that Joe leaves the upside on the table, but he does get to keep the premium. So he is skewing things to the downside. So let's say, for example, and this is a totally made up hypothetical example, but let's say you got QQQs trading at $591 and your typical strike at the money would be, let's call it $590. And this week, Joe is selling the in the money 580s. Well, he collects a higher premium because when you sell deeper in the money, you get more money as income, not all as income, but as premium. And a lot of that is in the money amount, but some of it is cushion. In this case, he gets $11 of cushion. The word intrinsic is not right there, so ignore that. But he does get $11 worth of cushion, and he gives up the upside beyond 580. So if it goes to 600, he doesn't get to participate in that. But he's not playing it that way. At least that's what he told me, okay? So if QQQ drops to 580 or below, he's already positioned defensively. Okay, so what can you take away from this? And again, this is just an opinion and education and certainly not investment advice, but you can learn from what Juicy Joe is doing. And he sees the risk of disappointment being greater than the upside surprise. So he's selling deeper in the money, income first, defense second, and growth is last, which is the way that covered calls are really designed. You're not trying to be an investor that takes advantage of the upside run. You're trying to be an investor that takes advantage of the juice, the income. And so if the market rallies, he gets to keep the premium. If the market slides, he looks like a genius by collecting the juice. So what I'm saying is, from what I've learned from him, is be protected in this market, because you never know what the Fed is going to try to do, or what the Fed will whisper about going forward, or whatever. I can just tell you one thing. I see a lot of volatility today and tomorrow, so you got to just be really careful, and I hope you are. So I need to put up a legal disclosure here. I am not a financial advisor. This video is for educational purposes only, and this is entertainment, and it's not financial advice. Always do your own research before making financial decisions, and please be careful.